Hello, welcome to the Financial Tactics Podcast, where we break down money moves and bust financial myths. My name is Gabriel. I am also known as the Finance Catalyst. On this podcast, we talk about things that are very important to you financially, especially when it comes to the area of investments, your saving goals, everything that has to do with, creating wealth and building the financial freedom that you require. So on this particular episode, this special episode of the podcast, I have a special guest for which we'll be having a very interesting discussion today. You don't want to miss this discussion because it promises to be interactive. We'll be talking about something that is very common in the financial market. But before we do so, I want you to go on the podcast channel. You rate this podcast 5-star. You share the podcast with your friends and loved ones, and also get to subscribe to the podcast channel. This will do a lot of good to us, and also it will help us, see how we are performing in terms of obtaining your feedbacks and so on and so forth. So thank you so much for joining in today. So today's episode is a very special episode. We'll be talking about, the stock market myths, every wrong decision that a beginner investor has made. So we're going to be addressing what are these stock market myths that we've seen across the stock market and some of the decisions that most beginner investors think about, when it comes to investing and how they want to go about it from the perspective of should I invest or should I not invest? So without wasting so much time, I want to introduce our guest today. Is Kieran. His name is Kieran. He's someone that has been in the stock market for a while, but I'll let him do the talking. So welcome on board, Kieran. Welcome to the Financial Tactics Podcast.
Man, absolutely. It's a pleasure. Thanks for having me on this podcast today. As for me, my name is Kieran, like you said.
Yeah.
I've been within the financial realm for, I would say, roughly 2 to 3 years.
Oh, that's great.
Specifically within the foreign exchange market, stock market, and also dabbled within the crypto industry also. Mm-hmm. But yeah, that's all for me.
That's really interesting. That's a lot of exposure in the financial market, because when you're talking about the financial market, you are looking at what forms of investment, which you just mentioned, like from the cryptocurrency space to stock markets, and dealing with, certain kind of risk instruments, risk management. So it's quite an interesting exposure that you have. So how long have you been in this field?
Well, I would say it was roughly between the years of 2022. That's when I really got, introduced to the whole industry, looking for a means to, increase my level of income. Mm-hmm. And yeah, that's how, I did it through a lot of research on the internet.
Yeah.
There was a lot of trial and error, but eventually...
It's always like that. Most times, when it comes to the financial environment, especially when it pertains to investment, at the beginning, you try to see how your investment goals are aligned, especially with the kind of portfolios that you have.
Absolutely.
So it's part of the journey, it's part of the curve. So today we are talking about investment myths, stock market myths, precisely. Now, and this is something that most investors, especially people that want to invest, they always hear about different kind of myths, and sometimes it becomes very difficult for them because every time they hear these myths, it's like they have a cold feet. They don't want to make the move. Yeah, so one of these myths, let's just dive quickly into it. One of these myths is the fact that I always hear people say that they always hear that they have to have a certain amount of money for them to be able to buy or invest in stocks. So this is one of the things that I hear a lot, because there was a time I was having a conversation. I was consulting with someone.
Okay.
The person I was talking to the person about investments. And the thing she mentioned to me was quite striking. It was like, I don't have the kind of money that I would need to start my investment journey. For me to be able to invest or buy this stock or buy this share or invest in this particular asset, I need to have, there's a certain kind of money I'm waiting for. Immediately that money comes, then we can actually focus on it. So now tell me, what's your take on such kind of, is this true or false, this myth of, having to have a certain kind of money before you make an investment? Is this a true or false myth?
All right, that's a very interesting take. Well, to start off with, I would say it's false.
Okay.
But of course, you will do need an initial amount of capital. You cannot invest with zero amount of your money. So
Yeah.
But yeah, it's completely false. For example, a lot of people, like you've mentioned, they say that they need a specific amount of money, and in their head they're really thinking like thousands of euros or dollars in this matter. But it's completely false. For example, let's say you wanted to invest in a very popular stock. For one of the many stocks could be Tesla, for example. To obtain one share of that stock would be, let's say that Tesla is valued at, let's say, around $1,000. If you wanted to, purchase this stock, you would say to yourself, okay, for me to have one stock of this or a share in this company, I need to have 1,000 euros. It may be a lot, but there's many instruments available online to allow you to obtain a fraction of that stock in order to, reap the benefits of the increase of that particular stock. So, for example, if you have $100, $100 to invest, you can obtain, I would say, 0.1% of that $1,000 share, and you can already start to, reap the benefits.
Yeah. So the power of compounding interest also.
Yeah, absolutely. So let's say you bought the initial stock at $1,000.
Yeah.
And over the next, let's say, roughly 2 to 3 years, it increased from, let's say we have a 30% increase. You will see the 30% increase on your $100, and that's if you begin with $100.
Yeah.
And let's also like mention the dividends.
Yeah.
That's also paid on that
dividend
stock.
paying stocks. Yeah.
And also the interest and the what's the rate? I mean, not the interest rates.
Interest rates. Yeah.
Yeah. But I wanted to also mention that one of the benefits is the inflation that you're beating.
That's important because when you are talking about inflation also, it's important for people to know that leaving your money in the regular bank account is definitely in the next couple of years will be destroyed by inflation. Now that's why investment is very important, because you sticking your money to putting it in a bank account that every month you get debited credit charges, maintenance fees, things like this. Even the value of that currency, you are not certain that in the next 2 years it will be the same. So why leave your money in a regular bank account when you know that in the next 2 years you can actually look for somewhere else to put that money, invest in a particular financial instrument that will give you a significant rate of return?
Absolutely.
So yeah, you're right.
Yeah, like you'll be doing yourself a disservice, because like I would say the average inflation rate is roughly around 3%.
Wow.
So I would say all you would have to do is do your research, do your due diligence.
Yeah, due diligence,
and find a stock that appreciates of around 10% per month, not per year actually, on average. So you can, beat inflation.
Yes.
Save that purchasing power for your currency and your hard-earned money, to be exact. So.
Wow. Yeah, that's very, very striking, because most times people think to themselves like, this is a myth that is very common, because they feel like there's a certain kind of money I need to get to before I start investing in a particular financial instrument, whether you're in the real estate market or in fact, the fact that you cannot even say, okay, purchase a real estate, because that's one of the tricks. Sometimes people feel like because the real estate market is very high, it's very expensive, and they cannot be able to purchase outright a particular property.
Yeah.
But we have several other forms of acquisition of real estate. There's the REITs.
Yeah.
You can do a co-investment program with people. You don't have to be the one to single-handedly raise such capital to acquire a property.
Yeah.
You can actually think of, you have friends, people that you know that are also investment-minded like you are.
Absolutely.
You guys can come together and say, okay, we want to focus on, acquiring a particular asset, a property. You can come together and say, okay, this is our amount of commitment that we are making to this, right? And based on that, you make returns on that property, because if you buy that property, maybe for example now, in maybe 2-3 years time, it has appreciated a lot. And then based on the commitments that each of you have provided, to invest in that property, you share the returns. Yeah. So it doesn't necessarily have to be waiting to get single-handedly that particular capital to be able to acquire the property. That's one thing that people don't know. in terms of when it comes to investment. So they have that kind of myth in their mind that, I must have this kind of amount of money before I can do this, which is not the case. So it's important that people tend to get to that point where they don't procrastinate their investment journey.
Yes.
Because when you start thinking about it, don't worry, I'll do it. There's the best time to start your investment journey is always now.
Yes, the present.
Because it's now. Because you never know. You never know what's going to happen. When it comes to the financial environment. So if you keep procrastinating, you might end up in putting yourself in a kind of dilemma that you shouldn't have been in the first place. Yeah. So yeah, what you said is actually very, very important. Now, so when it comes to the financial market also, there's this perception also that people have, and that in a way makes them a bit cautious when it comes to investment. So for you personally, how do you perceive this kind of situation? For example, you have a market crash. Okay. Would you rather be someone that, because of the market crash, you decide to say, okay, because I've seen how the market is, there's a serious crash in the market, and now, do you see that as an opportunity, or you see it as a kind of disadvantage, in the sense that you wouldn't want to invest because you are seeing that the market is in a dilemma? What do you think about such kind of perception?
Well, that's a really interesting question, because the market, that's actually the nature of the market, is to go up and down. You know? If it were to go up forever, then that would be pretty easy. The market has its own strategy, it has its way of flowing.
Mm-hmm.
So, me personally, I would not see it as something to be fearful of, because we need to keep in mind that we need to do the opposite of what the masses are doing. It's important to know that when people are fearful, that's when you should be looking for a way
opportunities.
An opportunity.
Yeah.
And when people are too greedy in the market, that's a way to exit. You have to always do the opposite of what the masses are doing.
Yeah.
And this is repeatedly happening every single time. So, like you mentioned, if there was a big crash, what would I do? Like I said, I'll be doing what the opposite. For example, let's take the average person that has no financial literature, no experience within the industry.
Yeah.
They blindsided, they purchase a stock, it crashes, they say to themselves, oh no, what have I done with my money? Little they didn't know that you only lose money when you sell. What they'll be perceiving would be unrealized profits. So knowing the nature of the market, especially if you did do your due diligence and seeing the track data of that particular stock or whatever financial asset that you've purchased, you will know that this is momentarily. It's the nature of the market to go up and down. You wait for it to break the higher highs, previous past, and continue to flourish. So during that down period, I would actually be looking to accumulate even more, because whenever a stock is devalued or has crashed, it's actually cheaper to purchase. So you have to see it, you have to perceive things a bit differently.
Yeah, exactly, as an investor. No, this is very important, because like you said, one term that people need to really know, it's in the stock market, is always used a lot by investors, the bear run and the bull run. Where you are, investors are either pessimistic about what's going to happen, or they are optimistic. Now, because when you look at it, the truth is, the people the rich guys that actually make money from the stock market are actually, these monies are made in times of panic.
Yeah, exactly.
And that is just the reality. So because when you see people that are in a dilemma of whether they need to put in more money or take out their money, because obviously when there's a market crash, there's a lot of things that can force that market crash. There's a lot of factors. But when you now start getting to that point as an investor, where you are now in a place of emotional investing, that means you are panicking, you are not sure what the market is all about, and because of that you make rash decisions. That is a ripple effect. And that's why I keep saying to the people I consult with that the first thing you have to do as an investor is to eliminate emotional investing.
Absolutely.
Because when you are emotional about your investment, you make certain decisions based off emotions that can lose you. You can end up losing a lot of money.
Yeah.
You see, so it's important when it comes to the market crash like this. People should see it as an opportunity.
Absolutely. Yeah.
Because like you said, the market will not. There's always downtowns in the market.
Yeah.
The market, if the market just keeps going booming, how will people make money from it?
Yeah.
Because the more expensive it is, other people that were trying to buy a stock can find it as a challenge. Because you buy it at this price, there's a high tendency that the next time you want to purchase again, it's not going to be at that price.
Yeah, it needs to be at a favorable price. Yeah.
Seeing a market crash people shouldn't, especially with beginner investors, they shouldn't get to the point where they see a crash as a means to now start getting to panic or to start making rash decisions. And that's why I keep telling people, those that are into the crypto currency space, that is a space that as a beginner investor, you should be careful about, because it's a very risky sort of investment. Because of high volatility, it has a high level of volatility, in the sense that what are we talking about here? There's the movement of the cryptocurrencies are moves, it fluctuates. So if you are someone that doesn't really understand the markets in that regard, and you are looking to invest in such kind of instrument, you end up losing money, because you have to make sure you get to that point where you do the due diligence and understand the kind of currencies that you are investing in. Because you are someone that you know that, of course, you are not someone that likes risk, because every investor has his level of risk appetite.
Yeah.
So it's more like understanding that there's always a risk and a reward to some things. And especially when it comes to the market crashing, your first response shouldn't be from a place of pulling your money out of the market. You have to understand why the market is in the way or the state that it is. And based on that, you make certain decisions. But I always talk about people, everybody has their own investment strategy.
Okay.
And it's always very important for people to see it from a place of, what's my investment goal like? Am I investing for the short term or investing for the long term? Because that is what will drive whatever you are doing with your money, right?
Yeah.
So I always advise people, before they even start thinking of putting their money somewhere, they should first of all define what the purpose or the goal for that investment is.
Absolutely.
Because once they are doing that, they are able to now identify, okay, I'm investing for this period of time. Okay, should I go with this particular asset, or should I go with this?
Yeah.
Because that's what determines, because there's a difference between investing to trade and investing to invest. I keep saying that, because if you are someone that is investing to trade, that means your strategy should be more of the short run.
Yeah.
Because you are looking at what are the potential opportunities you get in the short run to be able to generate funds.
Yeah.
So that way, even if you are going with investment to trade, your strategy will be different from someone who is doing investment to invest.
Yeah.
Because that's more of the long term. What do you think about that?
How do I see it is that, like you said, it really depends on the individual. They need to have a set goal.
Yeah.
For example, they need to allocate specific amount of their income. They have to, I will allocate this specific amount, this percentage, for investing.
Yeah.
Something that they're really comfortable with losing also. So once
that is very important. And that's what you just said. It's one of my rule of thumbs. When I invest, I am ensuring that for whatever I'm investing, I'm willing and able to, when I lose it, I don't feel it. That is one very important strategy, that people should know. Always invest what you are willing and able to lose.
Yeah. Because
the market is always very volatile. Yeah. So you never know. And that's why you see sometimes people are very, very, careful when it comes to risk taking, because they want to be sure that they are not putting so much of a risk into. But of course, if you look at it from a different perspective, the higher the risk, the higher the returns.
Yeah.
So yeah.
Yeah, like I was saying, they need to removing, that element of emotions from the amount that they're willing to invest is extremely crucial.
It's very crucial. Because
it will influence your behavior and when you're in times of drought. And it's something you really need to pay attention to.
Okay, so moving on, now we look at the stock market. There's a whole lot that has happened this year when you look at the stock market, especially when it comes to the US stock market, you know, the Nasdaq, the
S&P
the S&P 500, the New York stock market. Now, if you look at the market, you could see that there have been several factors that has actually affected the movement in the market, in the stock market, because of course, with the election of the new president of the US of the United States, and some of the policies that he initially stated at the beginning of the year that he was going to implement, you know, those some of these factors. Of course, you look at the market index as well, you know, indexation, inflation rates. If you also pay attention to the economic situation of the country, you know, some of these, would I say external factors or internal factors, have actually shaped how the stock market has been. So now, my question would be, now that we are in at this state, if someone was to give you $500, for example, what goes through your mind in terms of, it's okay, I have $500 to give you now to, I want you to help me do a set of investments. What are the kind of sectors, or what are the areas that might come to your mind at first when it comes to this?
All right. So when you talk about, you know, investing, you know, especially $500 into like stocks, the first thing that comes to mind is technology. Technology.
Okay.
Technology.
Why is that?
Why? I mean, let's look at the data. I mean, if you look between if I believe, correct me if I'm wrong, the past 10 years, we've seen an increase of like 20% on an annual basis. The data is there, okay? Yeah. I mean, as we know, like the technological industry, it's shaping the whole area, and it's something that you definitely need to get into. Well, where exactly would I put those $500? I mean, you need to look at, you know, the AI companies, companies that are really like working with these latest data. So we have companies like Meta, you have, what else? We have Microsoft, we have Apple. But to be more strategic about this, I would actually invest into the S&P 500. Which we all know, because these companies,
the index,
the indexes,
index funds,
these companies that are like flourishing in the market. The S&P 500 actually encompasses all of those.
Exactly.
Funds.
No, that's very important, you know, because one thing I keep saying also is when it comes to the stock market, you know, and that would take me to my next question actually, because most times people don't know so much about what the stock market is all about in terms of what are the kind of stocks that are important to pay attention to, or how they can choose, what are the criteria to choose the kind of stocks that is important. I had a masterclass few weeks ago. It was Stock Investment Basics 101. And on that masterclass, I shared a lot of important details on how you can spot the right stocks, because it's very important. There are so many. It's not rocket science though, but there's a lot that goes into picking the right stock. I cannot come here and tell you now that it's just what is trending. The fact that something is trending, like this particular stock is trending, doesn't mean it's the right stock for you. You see, there's a lot you need to look at. You have to look at the market cap. You have to look at the revenue of that particular stock. You have to look at their financials. Pick their PE ratio. Pick some key indicators as to how that particular stock is performing. So there's a lot of background work that goes into picking a stock. It's not just you just see this stock and just say, oh, that's what it is. No. So on that particular masterclass, I really gave a more in-depth details. You can find it on my YouTube channel. You just have to go on the YouTube channel and you'll see it. So on that particular masterclass, we talked about very important strategies for picking the right stock. So what you said is very important, because when it comes to stock investment, like just the same way you just talked about technology. AI is something that is rampant now in our financial world. Like
Absolutely, yeah, man.
most of these AI companies, they are booming, right? So for you to even start looking at that area, you have to have a background knowledge of what that company is all about. You have to do a background check, and that's something that every investor should do, not just beginner investors. You have to have a prior knowledge about the performance of that particular stock.
Yes.
And one of the ways you mentioned now, which will take me to my next question, is about you just talked about S&P 500, which is like a pool of over 500
top flourishing
companies in the US, right? So when you look at it, my question there would be for the S&P 500, or let's just say for index funds in general.
Okay.
Most people have this myth, or their perception is, do you think they should rather go for purchasing individual stocks on its own, or rather you think they should go investing in a pool of already diversified stocks? Like, for example, now you have the S&P 500 that is an index fund that that tracks the performance of over 500 companies in the US stock market. So do you think people rather should invest in individual stocks, like hot stocks, or I say in quotes, stocks that are really booming as an indie? Do you think they should just invest their money on an individual stock, or rather put their money in an already let's say diversified portfolio of stocks? What do you think about that?
Well, that's a good point you make. So like we've mentioned before, it all depends on like what that particular individual, the investor, is willing to lose.
Mm-hmm.
So let's go on to the topic of portfolio
diversification. Mm-hmm.
So now that you've allocated this specific amount that you're willing to lose, you now have to also divide it again into fractions of what you're willing to risk for, let's say, something that's like low volatility, and the data and the track record is phenomenal for you.
Yeah.
And then you also risk a second part of that fraction, or a third. It depends on your take, and you put it onto something that is more high risk, lucrative. So in my case, let's say I'll just give you an example. So I will allocate 50% of that income that I'm willing to risk towards, let's say, the S&P 500. I've done my due diligence, I've done my research. The data is there. It's going to show the returns over the the annual basis, pay the dividends, beat the inflation. And then, for example, let's say there's a trending, or let's say there's an emerging company, AI-driven company. You've done your research. You've seen also what is very important, the future plans of that company. You really believe on their mission. You can also allocate, your money towards that company, that emerging company. And although there is a risk, but it's something that you're comfortable with, So it all depends on the investor, what he really believes in, and also the research that is being taken place.
Okay. Yeah, that's quite very interesting. Yeah, because like when it comes to portfolio diversification, it's something that is every investor should be a part of. Instead of having to own just individual stock, which is also good, but you don't want to. There's an adage we'll always use. You don't want to cast all your eggs in one basket, because what you are doing there is you are not getting to the point where if anything goes wrong on that particular stock, it's like you've lost all your money. So rather than having one hot stock, my philosophy would be having a portfolio of 10 stocks that I can easily manage. In that way, what am I doing? I'm diversifying. I'm reducing my risk exposure, because like you never know if you just own maybe a Tesla stock, or you own a Microsoft stock, and you don't have other stocks in your portfolio. When there is a crisis, or like there's a market crash, and that stock is affected, automatically it's like if you have invested all your money in that particular stock, you've lost. And that's why most times I always encourage people not just to go for in as much that they are diversifying their portfolio, they should go for dividend paying stocks. They should prioritize dividend paying stocks over other forms of stocks. I'm not saying other forms of stocks are not important. They are also good. But why do you prioritize a dividend-paying stock over a normal stock, for example? It's because you have the chance of getting not just dividend payment on that stock, but capital gain, right? Because if, for example, you buy the stock at $5 per share, and maybe for some reason in 2 years, or let's say in 6 months, depends, that stock becomes $10 per share for some reason. And that stock also pays dividend. What do you mean? What do you get from that? You get an extra $5 on that stock as capital gain, and you also get a dividend payment on that stock also. So for me, I always prioritize going with dividend paying stocks over the others, because I believe that for my own strategy and my own personal goals, those are the kind of stocks I like investing in, right? But at the same time, we have to come to that point as an investor, especially when you're a beginner investor. Don't take excessive risk. And that's one thing I keep telling some of these investors that are starting up. You don't get to invest in a company you don't have any knowledge about.
No.
That is a very, very strong mistake to make, because there are so many companies out there that some of them are even Ponzi schemes. They are not very reliable. You don't even know anything about them. But because a friend of yours said to a friend of yours, said to another friend of yours that, this is the company that is going, that is booming now, is trending. And because you are seeing a return of 20%, please tell me, how does someone promise you a 20% return in 6 months and you think that form of investment is legit?
Yeah, man, it's really, that's really bad. You mustn't get like, how would you say, like mixed up with like a good performing asset and like not a Ponzi scheme, but something that is not reliable. You know? Yeah, you can purchase a stock and then it could go, let's say 20% in like 4 to 6 months.
Yeah.
But like, how often would you be able to repeat this?
Yeah.
You know, like it's not something trustworthy. You
because some people even if you are doing that, for example, you are investing in such kind of risky asset or commodity, that should not just be the only investment you make.
Yeah, true.
You should also, but at that stage, you have to come to a level as an investor where you already know your risk appetite. Because as a beginner investor, you shouldn't be going for very risky assets if you don't have a clear understanding of what that asset is all about.
Putting all of your
and then especially when you're not putting all your funds into that. Yeah. No, it's not. I won't say it as a wise thing to do. You know. So looking at it, I think as a beginner investor, one of the myths that most beginner investors have is they tend to see this perception. This is very common amongst Nigerians also, where they see a company that is just coming up. They are maybe starting into the forex market. They're trading forex, or they are trading some sort of financial instrument in the market, and because they are saying, "Oh, I'm offering you within the next 6 months, I'm going to be offering you about 20% return." That information alone is all they need. They don't even want to know whether. And that's the thing. When you need quick cash, quick money, you don't even mind going to do your research anymore because someone is offering you 20%. I'm not saying there's people that can offer 20%. It might be legit, but the most important thing is you have to be able to come to that place as an investor where you do a proper due diligence on whatever form of investment you are making.
Yes.
Don't just do it because don't put your money because people are telling you to put your money there. What have you done? What research have you done to ensure that this company is actually good and solid in terms of numbers, right? In terms of the direction that the company is heading. Because a company can start strong doesn't mean it will finish strong.
Yeah, that's true.
Right? So it's important that most of beginners, the people that are new to investments or investing in stock market, they have to come to that place where they don't just pick things or pick companies based off, what people are saying or what's trending, but they should pick it based off how does this impact my own financial situation.
Yes.
So that's one thought. I will always want to let people know. So wrapping up, actually,
Okay.
one of the questions I also want to ask you, for example, if you own a stock, right, and for some reason the stock drops by, say, 20%. It can happen.
It can happen.
Yeah. So, what would be your reaction to such kind of situation? Would you want to sell the stock immediately, or would you consider holding the stock for a period of time to observe the market, or what would be your strategy for you personally?
Okay. Well, me personally, like I'm as an investor, I'm in it for the long term.
Okay.
So I know a decrease by 20%, it shouldn't directly impact me, especially emotionally, as
Yeah.
I've allocated an amount that I'm safe to lose, absolutely. So being in a drought like that wouldn't affect me at all. I will just hold the stock. And like I mentioned before, like the market has its tactics, and just like any normal business, the nature of it is to go up and down, sometimes remain plateau, but also elevate. So in a time like in the drought, 20%, I would, if possible, I would take the opportunity and purchase more, if possible.
I completely agree with you, because there was something you said earlier there that was very striking. You already defined what your purpose for the investment was, and that's, you were saying, the long term. Now, because when you have such kind of situation where you are investing for the long term, that determines the kind of strategy that you approach. So like you just mentioned, having the investment for the long term means that even if your stock value drops by 20%, it doesn't impact you so much, because you know that you are holding long. And that's why I was saying earlier at the beginning of the podcast that there's a difference between investment to trade and investment to invest. Because someone who trades and loses 20% might take a hit, right?
Because like, for example, the average Joe, the person that does not do any research, he enters the market, in hopes to make gains. Hope, you see emotions, they're willing, they're like, creating a fantasy or an imaginative where they, somehow they get the money. But in the case where they were to lose money, like mentioned, they'll be, the emotions start to kick in, they're fearful, what is going on? And then they will sell the stock. And then because of fear of losing even more, they'll tell themselves, okay, I've already lost this certain amount, I don't want to lose more, So they sell, knowing that, but little did they know that they'd be, selling at a, better price for me to enter the market. So while they're selling, I'm buying, See, that's like the thing that I mentioned before, doing the opposite of what the average person would do. So,
Yeah, that's fascinating. So thank you so much, Kiran, for joining us today. So before we wrap up, I want you to just talk to our audience. What are your final thoughts, final words for especially those that are new to investments, beginner investors? What would be your advice to them, especially when it comes to these myths, stock myths that people do have, pop around from time to time? They keep hearing it, and sometimes they are not so sure whether these are true or not. So what would be your thoughts to them?
I mean, my thoughts would probably be is that, like, if it's too good to be true, it probably is. Don't fall for these people that, like, don't get me wrong, people that do give out services and information, the groups and stuff like that, they can be very helpful. But it's really important to do your due diligence. Do your research, find out, let's go a bit back. Find out which market you want to go into, whether it's real estate, like you mentioned with the shares. Find out if you want to go within the foreign exchange market, the stock market, the crypto market. Pick one market, study it, and then invest, and also invest what you're willing to lose. And if you're not able to invest what you're willing to lose, don't invest at all. That's the best option I can give you. But it's a low barrier of entry for most individuals like myself, a student, that I'm able to enter the market. So it's not something that is only available for people with high earning salary or high earning income. It's accessible for most people around the world.
Yeah.
So do your research, invest wisely, and reap the benefits.
Oh, that's good. Yeah, thank you so much for that. Yeah, like you've heard, Kieran. It's important to do your due diligence. Don't just invest because people are saying so. You have to invest wisely. You have to do your background checks, do your research.
Yeah.
Make sure that you are not putting yourself in a financial dilemma, especially when it comes to your investment journey. So thank you so much for joining us today. It was a great pleasure to have you on this particular episode of our Financial Tactics podcast. So viewers, you've seen everything we've talked about today. Don't forget to rate this podcast 5-star. If you enjoyed everything, you enjoyed the discussion, rate the podcast 5-star. Subscribe to the podcast channel, share it with your loved ones and your friends, and also don't forget to follow Kieran. His handle will be on the screen. You can follow him on social media and get to see what he does as well. So until I see you again in our next episode, always make sure to be financially healthy, financially sound, and make the right financial decision, especially when it comes to your investment journey. I'll see you again in my next episode. Thanks for watching. Bye.
That's
good. I hope